At independence in 1947, Pakistan's industrial base was extremely limited. The country inherited only 34 factories out of 921 on the subcontinent, and virtually no heavy industry. These early plants were mostly cotton textile mills, sugar, rice, and tobacco units, and together they contributed only about 7% of GDP. In fact, Pakistan began life as a commodity exporter with hardly any steel, fertilizer, or major engineering works. Most raw materials had to be imported. The new government therefore pursued an import substitution policy in the 1950s, banning many consumer imports, for example textile goods in 1952, to nurture local manufacturing. Generous US aid and the Korean War boom via the Colombo Plan flooded the economy with capital in the 1950s and under the first two five-year plans. 1955 to 60 government spending on dams, roads, and industry laid a foundation for growth. By the late 1950s, Pakistan was already self-sufficient in cotton cloth, and manufacturing output was rising briskly. About 7.7% per year during the 1950s, sectoral policy favored industry over agriculture, yielding rapid industrial expansion, even as the trade balance wobbled and agriculture was neglected. The 1960s proved a golden decade for Pakistan's industrialization. Under President Ayub Khan, 1958 to 69, macroeconomic stability and planning allowed industry to surge. Large-scale manufacturing grew at nearly 16% per annum in the early 1960s, driven by protective tariffs, tax holidays, credit subsidies, and export incentives. The state actively courted foreign investment and aid, notably US aid totaling about $500 million in 1955 to 58, building new factories in steel, cement, chemicals, and textiles. Major projects like thermal power plants, dams, like Mangla and Tarbala, and the Pakistan steel mills, with Soviet assistance starting late in the decade, were launched. By the mid-1960s, poverty fell and per capita income rose. The economy was often dubbed the Decade of Development, reflecting rapid growth in manufacturing and exports. Textiles in particular mushroomed. Karachi and Lahore became hubs of cotton, spinning and weaving, and by the mid-1960s the country boasted hundreds of textile plants. Overall, industrial output expanded so quickly that by 1964 to 65 large-scale manufacturing had grown at twice the pace seen in the 1950s. By 1970, however, Pakistan's industrial fortunes were changing. Two shocks marked the turn of the decade. First, the bloody 1971 war with India led to the secession of East Pakistan, now Bangladesh. East Pakistan had contained substantial industry, notably jute mills, rice mills, and shipyards. So its loss set back the country's industrial base and export earnings. Politically, the turmoil shattered investor confidence. Second, the 1973 global oil crisis sharply raised energy and transport costs. Industrials faced double-digit inflation and higher input prices. In this difficult climate, the new civilian government under Prime Minister Zulfikar Ali Bhutto dramatically altered course. Beginning 1 January 1972, Bhutto's government launched a sweeping nationalization campaign. Under the Nationalization and Economic Reforms Order, NERO, the state took control of 31 major enterprises in 10 categories, including all heavy industries like iron and steel, heavy engineering, petrochemicals, cement, power utilities, and large textile mills. Banks, insurance firms, oil refineries, and shipping companies were nationalized in a second wave, 1974, followed by 1976's nationalization of cotton ginning, rice husking, and flour mills. By mid-decade, most large industrial and financial enterprises were state-owned. These moves were intended as socialist reforms, but they discouraged private investment and led to widespread mismanagement. Industrial growth slowed sharply in the 1970s. According to contemporary accounts, nationalization of steel, cement, banking, and textiles in the 1970s discouraged private investment and bred inefficiency. The combination of political upheaval and nationalization undermined the dynamism of the earlier era. General Zia-ul-Haq's 1977 coup ushered in a partial reversal. In power, 1978 to 88, Zia rescinded many socialist policies and denationalized some industries. He returned thousands of small ginning and rice mills to the private sector, for instance. The 1980s also saw the rollout of an Islamic economy, interest-free banking, and a continued emphasis on private enterprise. Fueled by huge remittances from Middle East workers, Pakistan experienced steady growth. By the mid-1980s, GDP growth was often in the 5 to 6% range, and poverty fell significantly. Headcount poverty reportedly dropped to around 29% by 1986 to 87. Large-scale manufacturing regained momentum under new investment, and small consumer industries like household appliances and light engineering flourished. Defense links with China began taking shape. Chinese aid helped Pakistan lay the groundwork for its own arms industry, including tanks and missiles, a strategy that intensified after the 1965 and 1971 wars. Yet even as export-oriented sectors recovered, structural problems remained. By the late 1980s, public debt had ballooned, above 80% of GDP, and the energy sector was already under strain. In short, the 1980s returned Pakistan to growth, but it did not fully restore the 1960s dynamism. The 1990s proved an era of chronic instability. Democratically elected governments alternated rapidly. Benazir Bhutto in 1988–90, Nawaz Sharif in 1990–93, Benazir again 1993–96, Nawaz in 1997–99, with little policy consistency. Pakistan liberalized trade and privatized some state assets, but macroeconomics unraveled. Workers' remittances and foreign aid fell, inflation spiked, and external debt tripled. The nuclear tests of 1998 triggered US and Western sanctions that froze many financial channels and frightened away foreign investors. Even so, industrial activity persisted. Large-scale manufacturing grew on average about 4.8% per year in the 1990s. But this growth was uneven and accompanied by stagnating productivity. The public debt to GDP ratio climbed above 100% by 1998–99, and poverty and unemployment rose again. Key industries struggled under policy uncertainty. For example, although Pakistani textile exports had rebounded after the 1970s slump, they now faced new competition: Bangladesh, China, and sporadic power shortages. Overall, the 1990s saw Pakistan sustain manufacturing growth only at the cost of huge imbalances and very modest gains for workers. A brief boom and bust marked the 2000s. General Pervez Musharraf's regime, 1999 to 2008, initially steadied the economy. Early structural reforms and global tailwinds raised growth. GDP growth hit around 8% by 2004–5. Special economic zones and relaxations in industrial licensing attracted some foreign capital, and the stock market soared. Infrastructure investment accelerated, and major privatizations, for example telecoms, banking, modernized parts of the economy. For industry, the mid-2000s offered respite. Large-scale manufacturing grew about 4 to 5% annually in the mid-2000s. However, this success proved fragile. A crippling energy crisis emerged, with power cuts and fuel shortages slowing factories, and fiscal deficits reappeared. By 2008, after global shocks and internal mismanagement, Pakistan was again in economic crisis. Poverty briefly fell in the late 2000s, in part on growth and remittances, but inflation accelerated and the current account deficit widened. The industrial sector's expansion cooled. In 2008, LSM growth was roughly 4.9%, still positive but well below the decade's peak, and exports were hampered by rising oil costs and a stronger rupee. The 2010s have been a mixed bag for Pakistani industry. Continuing infrastructural projects, notably the China-Pakistan Economic Corridor from 2015 onward, and some modest reform provided new opportunities, but chronic challenges dominated. Textile and apparel remained the backbone of exports, accounting for roughly 8 to 9% of GDP. But global competition and domestic constraints kept growth muted. For example, Pakistan still has one of the world's largest textile capacity, hundreds of mills, and cotton production, yet profitability has been squeezed by cheap imports of yarn and machinery, as well as labor and power costs. Other traditional sectors showed limited revival. The sugar industry expanded to about 90 mills by the 2010s, and cement production roughly doubled. 24 modern plants. But these faced market gluts and infrastructure bottlenecks. Meanwhile, the automotive sector reached a new scale. Major players like Pak Suzuki, Indus Motor Toyota, Honda, and local tractor makers set up assembly lines, and yearly car and motorcycle production shot into the hundreds of thousands. Even here, high tariffs on imports to protect local assemblers, and currency swings often kept consumer prices steep. One notable success has been pharmaceuticals. From zero in 1947, it grew into a sizable local industry of over 700 drug firms, supplying most domestic demand, though many APIs must still be imported. Similarly, consumer sectors like packaged foods, household goods, and chemicals have expanded under rising incomes. Defense production also made gains. Pakistan developed its own tanks, Al-Khalid, missiles, Shaheen series, and the JF-17 fighter aircraft with China, even beginning small-scale exports of arms. Yet by 2020, the country's defense exports were still only on the order of a few $100 million annually, far behind peers. And Pakistan remained heavily reliant on foreign suppliers for critical military hardware. Throughout the 2010s, however, the same old problems haunted industry. Energy shortages are paramount. Factories routinely lose many workdays to blackouts, which dramatically cut output. Some studies have found that frequent load shedding alone reduced textile production by 20 to 30% in affected regions. In 2021, a nationwide blackout even inflicted an estimated $70 million loss on the textile sector. Political and economic volatility has also loomed large. Trade policies have oscillated. Protective tariffs on consumer imports were raised sharply at times, then lowered under pressure, and at times Pakistan even risked losing its GSP plus access to the EU over human rights issues. Frequent government changes mean regulatory uncertainty for investors. Moreover, Pakistan's industry is unusually dependent on imported inputs, machines, chemicals, oil, and gas, so external price swings matter acutely. For example, global oil price shocks now largely translate into domestic inflation and fiscal strain, as Pakistan imports most of its oil and gas. Foreign aid and cheap credit from the Gulf and China helped in the 2000s to 2010. Debt from China under CPEC surpassed $20 billion, but have also burdened Pakistan with large debt service obligations. In sum, by the mid-2020s, Pakistan's industrial sector had underperformed relative to its 1960s potential. Industries once championed as future drivers, like state-owned steel and heavy manufacturing, remain moribund, while the private industrial base contends with chronic electricity gaps, security concerns, and cyclical economic policies. By 2025, the refrain among analysts is that Pakistan's lost industrial might stems from a history of boom and bust policy swings. The country clearly has entrepreneurial capacity. For instance, it ranks among the top 10 global producers of textiles and third in Asia for spinning capacity, with over 15 million spindles. Yet the promise of those assets has often been stymied. Decades of nationalization, debt crises, and weak industrial planning dissipated the advantages of the early years. Even successful episodes, the 1980s industrial revival or the 2000s investment surge, were largely undone by later interruptions. Today's industries survive and even thrive in niches, but growth is fragile. Textile and apparel exports still dominate trade. Sugar and rice mills run at near capacity, and pharmaceutical firms export some generics. But any major expansion requires stable power, market access, and consistent policies. Pakistan's energy sector today still relies on imported fossil fuels, about 80% of generation. So global price surges tend to throttle factory growth. In short, industrial output has become highly sensitive to foreign aid, external shocks, and political will. Looking back, the narrative is clear. Pakistan industrialized rapidly under coherent policy regimes and generous aid in its first 2 decades, but then repeatedly lost that progress to upheavals and policy errors. Waves of nationalizations in the 1970s, alternating with partial privatizations, prevented sustained private sector development. Meanwhile, external factors like commodity booms and slumps, oil crises of 1973-79 and 2008, regional conflicts, 1971 war, sanctions in the 1990s, and trade shocks, new Chinese competition, the end of export quotas, continually disrupted growth. The result by 2025 is a mixed industrial landscape. Several major industries do exist. Textiles, 423 mills. Sugar, 90 mills. Cement, 24 plants. Autos, multiple assemblers. Pharmaceuticals, 700 plus companies, plus niche electronics, chemicals and defense. But none have grown rapidly in recent years. Industrial value added remains a modest share of GDP, hovering around 13 to 14%, down from its mid-century peaks, and most manufacturing firms cite energy and policy uncertainty as key constraints. In a nutshell, Pakistan's lost industrial might is not due to a single cause, but a concatenation of historical events. Early ambition and potential were undercut by geopolitical shocks, partition, wars, oil crunches, internally by policy U-turns, nationalization versus liberalization, and continuously by infrastructure bottlenecks, especially energy. The evidence is clear in the data. Sectors such as steel, Pakistan steel mills is now defunct, and heavy engineering declined. Automotive grew modestly, and textiles stagnated. On the other hand, some sectors like pharmaceuticals and consumer goods did expand under a more open economy. Recent economic indicators, Industrial Production Index, manufacturing share of GDP, have shown stagnation or even decline in the 2010s and 2020s, underscoring that the long-term trajectory has flattened. Analysts now emphasize that overcoming these obstacles, consistent industrial policy, energy reform, and integration with global markets will be essential if Pakistan is to reclaim any of the earlier industrial momentum.